Welcome to episode 235 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. And Nick, I want to ask you a question. Why the hell have my insurance premiums skyrocketed?
Skyrocketed, if not tripled. Unbelievable. We're talking about cost of living out there in society, but nothing has gone up more than insurance premiums.
Cost of dying, Nick. Cost of dying.
Unbelievable.
It's out of control. Can't even die anymore. It's ridiculous.
Well, you can, but your loved ones won't be looked after. This is the problem. So, everyone's talking about house insurance, car insurance, how much it's gone up. What's gone up at absolute exorbitant levels is income protection and personal insurance, which I strongly believe is the most important. What's the point of insuring your car if you can't afford to make the repayments on it or buy it? So you should definitely insure yourself and your ability to earn an income first and foremost. Unfortunately, at the moment, there is a lot of people out there that are cancelling covers because it's just out of control from a premium increase point of view. So I just wanted to unpack today why that is, what's happening out there, because we obviously are in that game. How can you get yourself insured at a decent price or a decent level that's going to keep you safe at least? Hopefully we all walk away from this going, yep, I know what I need to do now, and go and make some changes if that's what you need to do.
Yeah, awesome. Well, Nick, for people that might be totally new to our show, which I don't know where they've been living, do you reckon you can give us a quick breakdown of the differences between the insurances so we can get a bit of an understanding of what they're actually for?
Easy. 4 main types. First one, which everyone will know about and relate to, is life insurance. If you pass away, your beneficiaries will get a payment. If you had $1 million life insurance policy and you pass away, your beneficiaries will get $1 million. Second one is total permanent disability. Very similar to life insurance, except you haven't passed away. You just lose your ability to earn an income. So you're totally and permanently disabled. They're the two most common. Third one is trauma. Trauma cover is cover for an incident or a sickness or an accident where you would generally recover and go back to work. The three most common sicknesses are cancer, heart attack, and stroke. So you're really just covering for maybe a year or two of extra medical expenses. What if your partner needs to take time off work to care for you, hypothetically? And the one in question, which I think is the most important cover, is income protection. So if you lose your ability to work because of accident or illness for an extended period of time, possibly forever, you will get a percentage of your income paid out, in a lot of cases, until you're 65 years old. For me, that's the most important cover. Put it into real simple numbers. You earn $100,000 a year. You're 35. You are going to earn income till you were 65. If you lose your ability to earn an income at age 30, without even putting indexation into the calc, you've lost 35 years of $100,000, which is how much, Jace?
3.5 million.
3.5 million. Yeah, so it's actually, you look at indexation, you look at most people earning above 100.
Yeah.
If you lose your ability to earn an income tomorrow, you're hypothetically losing $5 million over the next 30 odd years. So very important cover. The problem is at the moment, it's super expensive, and it's actually, for a lot of people, unaffordable, particularly if they've got an existing policy they've had for some time. Marty, I know you've got more money than you know what to do with, so you probably don't have income protection. But have you seen, clients, business clients, mortgage
I've
clients?
seen friends that are sort of my age sort of saying, we know we should be doing something, and but we're not quite sure what to do. And again, I think cost is a part of that as well. But I think what's interesting is how do you calculate what you need? Like, because there's a bit of a call out saying the trauma cover side of it. Like, what happens if you get knocked over and it's quite significant and puts you on your back for the next 2 or 3 years? Like, do some people go in and say, all right, well, if that happens to me, the trauma cover will pay the debt off, will give me, $500,000 to live off over the next 5 years, and then that's what they choose instead of income protection? Or is it a combination of both?
Yep.
Because, I'm just interested, because that's a lot of the questions I get asked is going, well, we'd rather have a lump sum and then work it out from there. But I think that could be dangerous too. I'm sure there's something better.
Oh, of course. And, So to answer your question, yes, a combination is generally the way to go, because you don't have all your eggs in one basket and then something happens and you don't have protection in that area. But what you have for trauma or total permanent disability will impact your need on income protection. So I'm just going to put a real easy example. If you have a really good income protection policy that kicks in after 90 days, let's say you get cancer, your income protection kicks in after 90 days, that would reduce your need for trauma because you're going to continue to get an income versus the income stopping. So it's getting the combination right. Without giving advice, I like people to have every box ticked, but it's got to make sense from an affordability point of view. So maybe let me just explain what's going on with income protection premiums and what's happening out there and why they're unaffordable at the moment for a lot of people. And then we can talk about, okay, how can you get to a point where it is affordable? Quite some time ago, there was, call it a review into the industry or their insurance policies from insurance providers. And the reality is that older income protection products that we have, so anyone that's got income protection 5 or so years ago, they're very lenient in what they provide us, to the point where the model doesn't work. So I guess for what insurers were paying out to what they were getting in for premiums based on the policies that they had built, it didn't add up. So they were getting to a point where we're not actually going to be able to afford to pay benefits out if we don't fix this issue because there's not enough money coming in. So they've redesigned the income protection policies, and there's certain things that used to be available in old products that are no longer available. I'm not going to go into that now because that's a rabbit hole, but that's just the reality that if you've got an income protection policy now in today's 2025, we're doing this podcast, it won't be as good as the product that you could have got hypothetically in 2019. So the issue is that the insurers now do not want those old products on their books. They want everyone in the new products because that makes more sense for them from a business model point of view, which we can all understand. So what they're doing is they just keep increasing the premium on the old products until people pull the rug out and leave and go and do the new, either don't do anything and cancel or get a new policy. So what you're seeing is a continuation of these price increases on income protection. When this all first happened, it wasn't crazy for premiums to double over a 12-month period. That was when the initial review happened. And we thought as a business, okay, that's probably where it'll land now. We'll get some, incremental small increases like all insurance does, but it's not happening. Personally, I got my renewal last week, and it was a 25% increase on last year. So to the point now where I'm going, I've got to do something here, and that might mean I go into the new product, which doesn't have the same bells and whistles, but people are being forced in to make that decision now. So Jace, you've got income protection. Have you got a good advisor on board?
I do have a good advisor that I just trust the numbers, but I get letters and had a meeting with Macy recently and was explained kind of where it was at and what was happening and felt very comfortable with the numbers and the trade-offs. I think I was quite lucky in a way. I can't remember what it's called, stepped or whatever, the premium level versus stepped. Mm-hmm. There's one particular policy I got into over 10 years ago, which I've held on to, and I think it's pretty rock solid, given it's one of those older ones that was kind of capped or level.
Yep.
It's definitely, you've got my attention though, because we get clients asking if it's even worth it, right? Like they're saying it's eating into their budget, margins are squeezed, life's getting pretty expensive. You go to the shops and the average cost of a basket of goods is up. And again, you said the example before, like if you're going to insure your car, why wouldn't you insure yourself? It's, you're the biggest asset you've got. But when people are kind of asking those questions, choosing between protection and affordability, is there a method to the madness, or it literally just comes down to weighing up the options and presenting a plan and letting them I guess how much is guided by a financial advisor?
Yep.
People are trying to assess the value. Yeah.
And this is the problem that the industry is facing. And if I go back 15 years ago, which is probably when I first got insurance, maybe even longer, Premiums weren't so bad. Advisors were paid on commission. So it was insure for everything. And, insure to pay your debt out. Insure for your partner not to work if something happens to you. If you have a trauma situation, which you generally recover from, insure to get rid of your debt anyway. So millions and dollars worth of cover, which would almost, if something happened, even though you would rather be healthy, was almost like winning the lottery. So that was the old way of selling. And I say selling because that's what it was. I think now that the industry has evolved a lot, premiums have gone up. This is the way I've got to tread carefully here, but we would always take people through a process to say, in this circumstance, total permanent disability, death, not having an income, what would you need? Then from there, what does that cost? If that is not affordable, okay, well, let's look at the alternatives. And sometimes you will get to the point where you're looking at, based on budget and cash flow, what is affordable for the household, factoring in things like, I'm already investing, I'm paying the debt down, I'm putting money away from kids' school, I think I can afford to spend this on insurance. From there, what is the best way to spend it and what's going to give me the most amount of certainty if something goes wrong? Now, compliance-wise, I could get in trouble for that because it's, okay, well, you haven't taken the client's full needs into consideration and, maybe they should have spent less on education because they needed this. But you've got to show people what they would need in a circumstance and what that would cost and then guide them from there. But the problem with doing that and getting a client to agree to, oh, look, it's expensive, but yeah, we probably need it. If it doesn't work in the budget, they'll cancel it in 6 months' time and everything's been a waste and they're not insured. So I like to look at, there's a few things that are a must for me. Income protection, number one. I think you have to have that. And there is ways to get that cheaper. You can extend the waiting period by having a little bit of savings. You can have a 30-day wait, which means I'm off work for 30 days and I get paid. Or you can have a 90-day wait, which means I've got to be off work for 90 days before I get paid. Makes a significant difference to the premium. And if you ask me, most people can get by for 90 days. If they've got a financial plan, they should have rainy day money that will get them through 90 days. They might have some annual leave. It's when they can't work for 2 or 3 years. So you can go a 90-day wait on the new kind of policies. If you look at life and total permanent disability, what's the things you absolutely probably need to cover for? Your mortgage. You need to get rid of the debt. If you lose your ability to earn an income, you need to get rid of the debt. And then education costs. If it's a couple of $100,000 to educate your kids, you need to put that money aside. So you might have life and total permanent disability that's going to get rid of your biggest expenses in life. And then you've got an income protection policy that kicks in, which is generally 70% of what you would have earned. So you've got 70% of what you would have earned, maybe a little bit less, depending on the policy. But you've also got no mortgage and no education costs. So for me, they're the bare minimums that you should cover. And you can get that done fairly economically. You've just got to speak to an advisor and understand how to get the policy down a little bit. The other thing is with insurance, what traditionally happens is every year the insurer will increase your policy by CPI because the cost of living goes up. So you had $1 million policy, then you get a letter from the insurer, CPI is 5%, you've now got $1,050,000 policy. But in the meantime, you've paid $50,000 off your mortgage, you've got another $60,000 in super, and you put another $20,000 in your bank account. So effectively, your capital requirements have gone down by about $100,000. So your insurance over time should actually be going down to the point where you offset rising premiums by reducing your level of cover because you're increasing your asset base. So your need for insurance is less, whereas a lot of people will say, oh no, but I've been paying the premium for so long, so I want to make sure that when something happens, I get my $1 million. But that's not the way to look at it because what's the opportunity cost of paying those premiums versus putting it elsewhere? So it should be reviewed every 12 months. what are the big expenses that if I lose my ability to earn, I'm not going to be able to fund? Education and mortgages, they're the two main ones. And then find a way to skin the cat, for lack of a better word or phrase, that fits in your budget so that you're not thinking about cancelling it in 9 months' time, because then you cancel it and Murphy's Law, the minute you cancel it, something goes wrong. And we're obviously passionate about this, and you might be hearing the passion because we're on the other end of it. We're dealing with claims. We see the impact it has when people have insurance in place and something goes wrong. It is an absolute game changer. I can't harp on that enough. I think we've all had circumstances, whether it's not us or people close to us, who have relied on insurance, and I can't explain the benefit of having it in place. So I think you need to find a way to get it into your budget, and you need to find a way to get it to work, and you can get it done fairly economically. You just need to understand how to do that and the different options available.
Can I throw a challenge out here, and it's not part of anything that we've planned, but can you give me like a case study or a real life example of like each one that's real, it's happened? You don't have to use names, obviously, but like what happened, what was the circumstance, and what did it mean to the family or to the person?
I've got a great one. This is a case in our office. I don't know exactly, but mid-30s. This guy was in his mid-30s. Truck driver. I think I might have mentioned this on one of the earliest podcasts we did, but it's still a really good story. Mid-30s, had his own transport business, had 2 kids, had a mortgage and a partner, a wife. He got cancer in his knee, of all places. It was something like that. So got cancer in his knee. So he had a trauma policy in place. So that means that because he had cancer, he was off work for however long it was going to be. So he got a trauma policy. I think it was maybe 150, 200,000 that would replace his income, paid for extra medical bills. And then at the same time, he had time to recover. What happened post that is he got a staph infection in hospital, and they actually had to amputate his leg. So, shocking story. He lost his ability then to earn an income. Young family, mortgage. He had a total permanent disability policy. So the trauma covered him for the original illness. Unfortunately, lost his leg. So being in transport, lost his ability to drive trucks. So he got a TPD, a total permanent disability payout. So that TPD payout paid out his mortgage. So he had no debt on his house. And then he had an income protection policy kick in, which would fund him until he was 65 years old. That's one example.
Wow.
I have another example who's a close friend of mine, and I've actually thought about doing some work with him to promote the importance. And he wouldn't mind me mentioning this, but he's my age, was a physio, super fit, healthy guy, wife, 2 kids, has had 3 strokes over the space of sort of 10 years. Issues all around balance, sight, basically can't work. He had an industry super fund with a default insurance policy inside of that fund. What I mean by default, super cheap. So if you're with an industry fund, you might have a default policy in there which will be super cheap, but very limited in what it pays out. So it might be like $100,000 or $50,000 or $150,000. So that's all he had. He didn't have proper insurance in place. So he's lost his ability to earn an income with a young family and maybe $100,000. It just doesn't actually go anywhere. So couple of examples there of people who were okay because they had all of the insurance, and what it can mean for people that don't have it in place, particularly if they've got a young family and they're a significant contributor to the household income.
Powerful stories there, Nick.
Yeah.
A couple of questions. The income protection, is it 75% of the income that you actually earn that you get through a policy, or has that changed? And the secondary question to that is that where trauma plays a bit of a part to sort of bridge the gap to get a lump sum in and provide some sanctuary as well. What are your thoughts on that?
Yeah, perfect question. Because trauma is always the question mark. Trauma is quite expensive because there's far more chance you're actually going to get paid out on trauma. Cancer, heart attack, stroke, these are things that are happening everywhere. So to answer your first question, it's now 70% based on the new policies, and you have to demonstrate that you're earning that income when you claim. So if you look at a trauma policy, a real basic example might be, okay, well, you haven't got a heap of money put aside. You've got a little bit of money put aside. But effectively, if you have cancer and you go through chemo and you're off work for 2 years, you're going to lose 30% of your income. So let's bridge the gap on that with the trauma, hypothetically saying 2 years, and you can only really work on hypotheticals. Then I would suggest people would think about their partner. So if you have a significant issue like cancer and you're going through a bout of chemo, what impact does that have on your partner's ability to work? Are there kids? Do they need to pick up the slack with kids? So you might find that, okay, you're insured because you're sick, but you either need to hire a nanny, hypothetically, your husband or your wife can't work for 12 months because they're caring for you. So you need to possibly think about replacing their income for a certain period as well. Or you might think about extra medical bills that aren't covered under the PBS. So there are some theories on what that should look like ideally, but typically you'll see people with between 100 to 200K of trauma, 200,000 of trauma, and it could be to cover any of those circumstances. Are you replacing the income of a partner? Are you allowing for extra medical bills? Now, some advisors will hear what I'm saying and they will say, nowhere near enough. You need to cover the mortgage, you need to do this, you need to do that. And I would suggest in an ideal world, yep, that is the case. But being in front of clients, what I can tell you is people aren't happy to pay those premiums. So it's looking at the situation, looking at the what ifs, taking into consideration things like family support. Okay, well, have you got wealthy parents? Okay, well, we need to think about that. Even though some people say, well, you can't rely on that, I'd say, well, if it's a difference between you being able to afford a premium or not, have you got family support? So all these little things, you got to have a deeper conversation, and that's not what was done in the past. It was, you should have all this cover in case the world ends.
Well, you make a good point. I reminisce. I think I was about 34, and I had a little medical incident, and I had income protection in play, but because the employment circumstance changed, I was a business owner instead of working and having a regular income coming in. All of a sudden, they couldn't justify the income. Now, it didn't work out. It was as bad as I thought it was, which was good. But that was interesting. That was like, like you said, you have to substantiate the fact that you're earning that income.
So that's a really good. That's a really good example, because if you go back to the old policies, there was an indemnity level of cover or an approved level of cover. So on an approved level of cover, you just had to demonstrate what you were earning at the time that you got the insurance, and then you never had to show that again. So if you had an approved level of cover, they wouldn't have even asked you for financials. They would have just given you what you were covered for. If you had an indemnity level of cover, they were cheaper, but you had to demonstrate your earnings at the time of claim.
Yeah.
So now you cannot get an approved level of cover. They don't exist. So now this is an example of the reduction in benefits with the new policies. Now it's all indemnity. There's no such thing as improved. So, but what we're doing in referring to income protection is saying, hey, this is what the old policy included. This is what the new policies look like. So this is what you're going to lose. So are you willing to sacrifice these few benefits to save this amount per month? And for most people, it's a yes, because the old policies just become unaffordable.
Yeah, but watch change of circumstance, because that's really Even though it would have been nice, right? But it came unstuck on that. And I thought, oh, interesting, paid a lot of money for that.
Again, this is why whether you go to an insurance specialist or you go to an advisor, annual reviews. What's going on? What have I got? Have I got cover that I'm paying for that in your circumstance I'm not even going to get paid on? You see that a lot too. So it's not set and forget, which is why I really have an issue with people doing insurance like this over the phone, because you don't have a deeper conversation around advice. And it's all about how much is the cover and how much do I get and what's the premium. The conversation should go much deeper than that.
I have one more question for you, Nick, if that's okay.
Yeah.
I have a lot of tradie clients. Now, a lot of my tradie clients are with CBUS, and, I'll have the conversation, need to look into your income protection insurance. Are you paying anything outside of, super? And it's, no, I'm with CBUS. It's all good. CBUS are great. Don't need to worry about it. When it comes to industry funds, an example like CBUS, like, is there anything extra people should be aware of? Like that, as you said, do an annual meeting with your advisor, get things looked at, have a broader conversation. But just any things, any red flags?
Well, let's talk about industry funds first. So where they are great is they do have what's called default cover. And that default cover is traditionally fairly cheap. The problem with default cover is it is never enough. It's just never enough. If you put it into 95% of people's circumstances, if something goes wrong, the default cover won't be enough. What has happened over the last few years, just as all insurance policies are getting repriced, that default cover is not as cheap as it used to be. And in a lot of cases, it makes sense to get insurance outside of the super fund from a normal, and even sometimes replace that cover from a normal provider. CBUS, they've been dragged through the mud a lot lately, if anyone's read in the media, but they were not paying claims. So ASIC have taken them to court around their timeliness of paying claims. Big issues at CBUS. So outside of that, you've also got premium increases. So CBUS's cover for what they provide is actually very expensive. And in most cases, you'll get a better cover elsewhere. And obviously there's the whole court case around them delaying payments of life insurance. And Jace, what I can tell you is if you have an event where you pass away, the last thing that you want is your loved ones and your dependents not being able to get their life insurance policy. Like, you think about everything that's going on when you lose a loved one, then to not have the money you thought was coming in. Some of these policies took over a year to get paid, and CBUS, this is their own estimation. They self-declared like $20 million in losses that people occurred because of it, whereas ASIC are saying it's far more than that.
Yeah, wow.
But there was a certain percentage there of their claims that took over 50%, that took over 12 months to get paid. Now, when you've got your husband or your wife mourning, trying to sort out affairs, and money doesn't come in, I can't explain the impact that has emotionally and mentally.
It's huge.
So if you've got insurance in your super with an industry fund, in a lot of cases, it won't be suffice. And I would encourage people to at least understand what they have, what they're paying for, and what benefit it will provide, and then compare that to what is available in the normal insurance market with a company like AIA, TAL, NEOS, the big insurance providers.
Jace, I got a question for you. What's tax deductible and what's not in regards to insurances?
Pretty simple, mate. I love a nice, easy question for me at this point. Income protection. So income protection is tied to your ability to earn income. Income protection, when you get paid out, is taxable income. And then therefore the nexus or the connection between the deduction is that you get to claim a tax deduction for your income protection policy as long as it's paid personally. If you're paying income protection through your super fund, then your super fund will claim the tax deduction within the super fund environment. But it's one that, with a good advisor, you'll always be considering, should I pay for my income protection personally? Should it be paid by the super fund? Where's it more affordable, and how to structure it all? All the others are not tax deductible, and that's why a lot of the time, life, TPD or trauma and these different policies are handled through the super fund or kind of balanced it and
And can
structured
you
it that
claim
way.
the full amount of the premium on income protection if it's outside of super as well?
Yeah, pretty much most of it. I think sometimes there's some fees where it might be a little bit of a split of income protection and a little bit goes towards trauma or other things. So it's actually very important. If you think you're paying it all to income protection, this is a big one, off the back of our tax planning convo recently. The ATO is now getting data of your tax deductible income protection premium. So if you're paying $120 a month, but it's 110 is income protection and $10 a month is fees or something else that goes elsewhere, and you just tell your accountant, yeah, it's 120 a month, bang it through, no worries, you may be in line for an ATO review or audit if you're not plugging the correct number into the income protection premium line item of your tax return. So future warning for next year's tax returns when you're doing it, make sure you've got that notice from your insurance provider that says this is your tax deductible premium for 2025. Good question, Marty.
Yeah, one little hack that I love this hack. Now, there's other things to consider, and so I'm only talking tax here. When policies are inside a super, there's other things you need to consider that they may or may not have. So ignoring that, the other really cool hack, Marty, is use your super to pay the premiums and make a contribution to your super fund to cover the premiums and claim a 100% tax deduction for that. So prime example, someone's on 150K a year at 12% super contributions from their employer. So they might be putting, I'm just rough numbers here, 17 grand a year into super, whereas they can put up to 30,000 now as a concessional contribution. Mm-hmm. If you're paying your, let's say your insurance premiums are 4 grand a year, and you're paying that from your super, so your super is paying those premiums for you. That can be advantageous because of cash flow, but the negative impact that has on your super is significant. So if you have the ability to offset that by putting money into your super, then that is what you should be doing. So 150,000, I've still got 13 or so thousand a year that I can get into super and claim a tax deduction for. I'm going to pay all my premiums from my super fund, and that's 4 grand a year. I'm going to make a 4 grand a year contribution to my super fund, and then when Jace does my tax return, I'm going to claim that 4K as a tax deduction because it's a super contribution. So that's a really cool hack that I love for people that still have plenty of room in their concessional cap and don't have the cash flow to make the full gap payment. So in this case, 13 grand. I don't put an extra 13 grand a year into super because I just don't have that cash flow, but I've got the cash flow to fund premiums. So I'm going to do it that way. A few other things to consider, as I said, around the policies, but that's a cool hack too.
What about, Nick, last question, promise, but what about the difference in quality of policies within super to outside of super? Is it just individual circumstance, or has that improved a lot within super? Because I once thought, this is going back a long time ago, that sometimes the cover outside of super was stronger and had better qualities around it. Has that changed, or is that still similar?
It has changed slightly. And it's back to my previous point. Those amazing whiz-bang policies don't exist anymore. So the gap has reduced. The gap between inside and outside of super is not like it used to be. Because of a lot of those benefits that don't exist on the new style of policies. But again, mate, it's just understanding it. It's understanding, well, okay, if it's inside super, what do I lose? Am I okay to lose those benefits to gain a tax deduction or, to minimize my cash flow impact? But yeah, you are exactly right. Going back on the old policies, far better to have them outside of super based on the benefits. That gap is reduced.
So now it's pretty consistent across the board regardless, which is good. That's good because then you can.
Here's the thing. And again, I could get trouble saying this stuff, but I'm saying it anyway.
No one's listening, mate. It's all right.
If you are with most good income protection policies through a good insurer, if you are really sick and you have a significant accident, and you've declared everything on your application, so you haven't lied on your application when you got it however many years ago, there's a pretty big chance you're going to get paid. What the old policies did is when it was borderline, there was more chance you would get paid. The new policies, you have to be, it's just more black and white on the new policies. So I'm confident with the new policies that most people are going to get paid if they're significantly sick or have an injury.
Okay, great. Sounds much more consistent.
The info in this app, like I know we get together, we record these apps, we do the numbers plan because we want to help people have better lives and we care about our clients, and there's only so many people we can help at any one point in time. And this is our way of kind of reaching out to a broader audience to offer education and whatnot. But this one's an absolute must. Like the more that I've listened to the stories and then heard the real life case studies, that is real. This is real help that people can get. So if you look at an insurance and you're insuring your car and your house and you haven't even thought about, what's happening with your own personal insurances, this is your chance to review your risk management strategy. Go and book a meeting with the team at Innovate. I'm sure it's a complimentary consultation to get the wheels turning. Go to inovayt.com.au, click a little link, book yourself a booking. It'll be probably the best thing that you ever do if you don't understand this stuff and you haven't got it set up. Education and understanding is key. This has been the first step listening to this app. Go and make that next step now though. Yeah. I usually say like the episode, share, rate, whatever. Bugger that. Run and book yourself a meeting to have a talk about this stuff because it's super important. Then come back and give us the 5-star rating.
One more thing.
Go on.
It's not just, hey, I need to check this out and get some cover. If you're getting the letters and the premiums are skyrocketing, do not cancel it. Make a phone call to an advisor because there can be changes you can make to that existing policy to reduce it. Or you could replace it, given there's some other things that need to line up for a much cheaper cost. So don't go, this is too expensive and just cancel it. Do some research around how to reduce that cover, number one, and can I replace it for a much cheaper policy?
Yeah, and that's another case study, the one where people have cancelled their policies, then can't get back in the market because of how much more it then goes up. So no, absolutely vital piece of information. Thank you. I appreciate that addition there. Until next time.
Protect yourself, protect your family. You're worth it. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.